Welcome back to another episode of Fun Friday with a special guest here. Someone who's got some really interesting outlooks on the market, very great experience. Welcome here, founder and CEO of CQ Capital, Chris Salerno. How are you today?
I'm doing phenomenal. QC Capital, by the way, but I'm doing
QC.
phenomenal.
Oh, I'm
Yeah.
dyslexic. See, I knew he was
Hey,
going to do something off right there.
I am too, so don't worry about it. But no, hey, excited to be on your show. Talk a little bit about multifamily car washes, where the commercial real estate market's going. You guys are a wealth of knowledge over there at Lone Star Capital, so excited to have this conversation with you guys.
Without a doubt. Well, let's get into your story, how you're in the chair today, your kind of background, the origins, and kind of how you maybe thrifted and nifted and kind of went through kind of to where you are now.
Yeah, most definitely. I've been in the real estate sector for over a decade now. First started out in the brokerage of single family real estate, where in the first year and a half, I built a brokerage company here in Charlotte, North Carolina, producing around 40 million in annual sales. After that, I sold it to a larger firm and I became their COO, oversaw all their operations, training, you name it. From there, brought them from 92 million all the way up to over 147 million in about 2 years. Very quickly, I realized that Uncle Sam wants his fair share of your income. And I needed to figure out ways to reduce that tax burden. That's when I started educating myself. And funny enough, the guy who I used to train, he runs now close to $300 million in sales brokerage here in Charlotte. He came to my desk one time and we all had cubicles. He came to my desk and he said, Chris, have you heard of this guy named Grant Cardone? And I was like, no. And so I started following him when he had like 300,000 followers on social media. And a lot of people don't know is that you can go to sec.gov and pull up PPMs. And so I ended up figuring out by tax records what LLC, bought that particular property. I then went to the sec.gov, pulled up his PPMs, printed it out. And for the next 3 days, I would read through the PPM. Now, don't get me wrong. I fell asleep a couple times. Like it was boring. But I read through the PPM because I was so fascinated and I wanted to understand how multifamily syndication worked and how syndication worked as a whole. A lot of people that you and I both know we're syndicating multifamily assets, but you can syndicate anything. I mean, Elon Musk syndicated Twitter, now X, essentially. So you can syndicate any type of deal, not necessarily real estate, business, anything. And so I wanted to get an understanding of it. So after analyzing that, I told the buddy who gave me Grant Cardone's, Instagram. I said, hey, I'm getting out of the brokerage industry and I'm going to go create my own private equity shop. And at that time, I knew I needed a leader who was in the space for quite a while. I connected with Joe Fairless with Ashcroft Capital. He had a private group. I was able to get into that. And then from there, I was off to the races. End of 2018, beginning of 2019, created QC Capital. And we solely focused on multifamily acquisition. So multifamily, essentially, we started with your traditional value add Class C, 1980s and 90s product. Very quickly realized where the market was pivoting to. So then we pivoted to the Class A, B plus type of light value add. And then in 2022, we were getting crazy rent bumps. I mean, $200 to $300 per unit on a monthly basis for just throwing paint and carpet. And I said, this won't last long. This is not going to last forever. It won't last long. So we sold off half of the portfolio and then we pivoted into the car wash sector. So now all we do is focus on our car washes. We still have multifamily that we're managing. We're going to hold those and then have a exit on those. But when it comes to our main focus right now, we are in the car wash sector. We are not leaving. We're here to stay in the car wash sector, and we're growing a large portfolio in it for our investors. So we're super excited about it.
Awesome stuff there. So a lot to unpack. First off, I didn't know that you're a realtor prior to this world. I was as well. And similar to you, I was kind of looking around at one point. I was like, okay, I don't want to be showing property in 115-degree weather in Phoenix. Kind of brutal, not very scalable. And your ability to make money is kind of predicated on you being in your local city. So there's no locational freedom, which is kind of a bummer. I'm not saying I want to be fully nomadic, but I don't want to be somewhere, basically 365 year round and have to worry about, taking time off that, I can't, kind of do my duties and stuff. And obviously you can scale it, you can get leverage, but it's still very difficult because people really want to work with you. So that's very interesting there. And it's funny that you got...
Sorry, go ahead.
You go.
What was a really big eye opener for me was I was in Gary Keller's top 25 with Keller Williams. And when we were you analyze a P&L. So the top 25 around the world with Keller Williams will sit down once a year and analyze P&Ls. and I analyzed the top person's P&L. I think his name was Bill something. He was out of Maryland, dressed in three-piece suits, very similar to you. Always dressed sharp. You and Rob, and he was doing around 1.1 billion in annual sales, but his take home was like 3.5, 4 million. And we were at that time producing like 120, 130 million in annual sales. And our take home was like only 700,000 less than his. And so I scratched my head. I said, well, to get to 1.1 billion in sales, that's a lot of effort. That's a lot of time, but your bottom line doesn't grow that much. And I said, you're limited big time. And that was a big eye-opening experience for me for another reason why I pivoted outside of it.
Yeah, no, to your point, and kind of to bring it home, is the scalability to your portfolio, what you're doing, scaling up and whatnot in the private equity space or in the finance space is just drastically higher from a return on time perspective. There's great livings you can be made. It's a great vehicle to put cash into your pocket to invest. And ultimately, the way I looked at it, I'm sure you're similar to this, is I'm just looking to get to enough money in my pocket, enough dollars invested so I don't have to work. I'm going to always work, but I don't want to have to work. There's a big difference in that mental switch there, right? In that paradigm. So I wanted to get enough cash in my pocket, enough dollars invested where I have optionality in my day to day, in my life, locational freedom, so on and so forth. And the vehicle that I saw to get me there quickest and most efficiently, and for my happiness as well in the day to day, would be to kind of transition from actually being my own boss to, working in the loan capital ecosystem, which is excellent. I'm very grateful for it. But, there's no right or wrong or way to do it. It's just what card you want to get in there and what do you think will be quickest and something that you can execute on. So that's kind of what I found there. Did you have kind of similar thoughts about just kind of scalability once you kind of saw those numbers? Like, wait, this guy's got to deal with way too much nonsense in order to kind of make that money?
Yeah, most definitely. I think the scalability, you were really there was a ceiling, and I realized that you can scale it, but you're going to hit a ceiling, and when you hit it or even come close to it, the bottom line net operating income is really not that drastic for the amount of work that you need to put into it. And then like you said, you're really locked in. So if I grew a 200, 300, 400 million dollar sales brokerage here in Charlotte, I'm locked into Charlotte. And I can't really, yes, I can travel, but it's going to be very difficult to unless you have the right people in place, things like that. So, and if you're going to, pivot to the brokerage style of creating your own brokerage, which a lot of groups are doing nowadays. So yeah, I realized all that. And the great part about what you and I both do is that we do have the freedom. All we need is good Wi-Fi and a MacBook computer, and we're good.
Excellent. Yeah, I couldn't agree with that more. So let's get into the multifamily. You started acquiring multifamily. What was kind of your time in that space when you roughly started?
Yeah, so that was beginning of 2019, and really, we still have multifamily, so we're still in it. We're just not acquiring. But from
Right.
2019 all the way up until 2022, we were heavily acquiring. We acquired one deal at beginning of 2023, and that was our last deal. So other than that, we really stepped away from acquiring multifamily. Now it's managing the current multifamily assets that we have to prepare them for a sale. And then our main focus is just strictly the car washes.
Yeah, and it's kind of interesting actually to that point there. I don't know if you're privy to this or not, but Rob similarly, I believe, was in probably the same group as you with the Joe Fairless setup.
Yeah.
He's kind of one of the early kind of founders of, the syndication world and whatnot. Him, the Rod Khleifs of the world. It's pretty cool. I don't know if you were privy, but or even if you were in the same class there, but super cool that you kind of found that there and then kind of made it to the next step, obviously, and found your way. But let's talk about the multifamily space. So one thing we were talking about before here, and something I actually fully agree with, which is, before you're in the space, when the game was really easy, kind of that 2019 to 2022 period, right? And 2022, the world changed a bit, the interest rate environment changed a bit, right? But expectations, putting $1 in and getting $2 back was super easy, right? So can you kind of talk about what you were experiencing then, just to kind of, go over how hot and how drunk everyone got on the interest rate environment and the growth world that we're in at that time with dollars being printed all over the place?
Oh my God, yeah. The biggest thing is when I was a residential broker, I flipped houses. I flipped a total of close to 8 homes in my life. And it was quick. You buy a house, you have the contractors lined up, you have all the material already ordered. They come in, demo, knock everything out. In 60, 65 days, you have the house back on the market. You run a tight ship, and you can make good profit. And I think a lot of people really took that philosophy during those times of 2016 to upwards of 2021, where the cap rate compression helped tremendously, where a lot of these people bought deals. And I saw one deal in Raleigh, North Carolina. They bought it for $40 million, and 14 months later they sold it for 85. And I was like, holy cow, like that's wild. Congratulations for them and their investors, but that's not normal.
No, that's a hot potato.
I know whoever bought that, good. I don't know what they're doing now, but the sellers walked away very, very happy. So don't get me wrong. You take advantage of the market when you see opportunity like that, when you can buy and sell for huge profits. However, a lot of people thought it was going to last a lot longer. A lot of people got in at the wrong time and actually bought when the potato was too hot. And, we're seeing a lot of explosion right now. But that was the big, eye-opening is when you see those and investors' expectations. I remember having calls with investors and we would have calls and they were like, I'm in the mid to high 20s for an IRR. And I'm like, well, I'm sorry to let you know, but we're in the high teens and we're trying to get to 20, but I'm not going to stress it. We can easily stress it by decreasing our, exit cap, but that's too risky. So I was like, we're in the mid to high teens. And then I remember as time went on, we would tell investors, hey, we're in the low teens for an IRR. And then their expectations came down from mid to high 20s to high teens, low 20s. And so you slowly started to see that, every 6 months, his expectations going down. But I think a big thing is, and especially right now, investors need to realize is that multifamily is not a game that you are going to flip in 12 months, 2 years and sell and double your money. Now, don't get me wrong. You may have that diamond in the rough where you can do that. But most deals, no. Multifamily is a 5 to 10 year play. And I like to tell investors, expect a 5 to 10 year hold. That's normal. That's playing the game Monopoly, but in real life,
That's healthy.
Multifamily. Oh, 100%. Very much so. You have a physical backed cash flowing real estate asset. People need a place to live. Expect a 5 to 10 year hold. I think a lot of investors got really greedy over those times. And now they want, a 2 to 3 year hold or a 4 year hold. And that's not the true fundamentals of multifamily. The true fundamentals, in my opinion, of multifamily are 5 to 10 years.
I could not agree more. And we're actually projecting every hold to be a 5-year hold period. But we typically speaking take out somewhere between that 5 to 10 year kind of treasury note or debt note right there. So super great there. And I think there's a couple things to unpack here and a couple of lessons. People get very greedy off of, maybe past performances, or the worst thing that actually a sponsor can do is try to stretch their numbers and change their underwriting to mirror and match what people and the other people in the industry are kind of projecting on their simulation and on their kind of underwriting, right? Because if you've got the same deal and give it to 10 different sponsors, you're going to get 10 different projections, unfortunately, right? God. So there's a lot of, kind of tinkering, playing with numbers, assumptions, so on and so forth in that underwriting model that derives to, that mid-teen return. This isn't just a deal where, hey, you put this and that on and you get a mid-teen return. No, this is factoring in property taxes, insurance costs, all these different moving parts need to be buttoned up in there. And what happened is a lot of sponsors, frankly, wanted to raise money or felt like they had to, really compete with everyone. And the way they were doing it wasn't sticking to their guns and their projections, but what they were doing was really kind of, frankly, giving bogus numbers to kind of appease investors. And that's really set a lot of bad habits. And then there's also a lot of investors out there that are unrealistic about what returns actually need to look like. Seeing a 20 IRR does not make sense. Maybe if it's 2-year period, if there's a certain unique situation, you can get that. But for there to be a 20 IRR over a 5 or 4-year hold period projected on numbers, that just doesn't make sense. So were you seeing a lot of people kind of asking for those numbers, kind of not realizing, or maybe were going to find themselves in a tough situation because they were just going to work with a sponsor that kind of, hate to say lied to them, but exaggerated, I guess, maybe for a more proper word?
Most definitely. I mean, we saw that. I remember 2021, 2022, I'd go back to our underwriting team and I'm like, hey, is our underwriting model, like, is there a formula that's not working? Like, we are getting beat out left and right. Like, how are these guys making the numbers make sense? Thankfully, we had really good relationships with brokers. So, they would give us a very close guidance on where the property's under contract at. And we would plug it into our model and we'd say, it just doesn't make sense whatsoever. And we had a lot of investors at that time would go to other deals when we had a deal because they were projecting higher IRRs. And I think a big thing with IRRs, it takes into consideration time. It also takes in how long your investment's been in that vehicle. And so it's super important to really analyze everything. One thing that really opened my eyes past couple of years, and I tell all these investors, is that you can look at a multifamily deal. It can say 8 to 10% preferred return, but what's the year one cash flow? If the year one cash flows 3%, well, how are they making up that difference? Are they raising additional capital to pay out that first year? If you're okay with that, that's fine. If they're not, then how are you making that
Known
difference?
as the Joe Reserve.
Yeah, I know, right? Most people will, look at that and see an 8%, expect that 8%, and then when you're only paying out that 3% year one, they go back, well, I thought it was 8%. And that's, and not a sophisticated investor to understand that if the property only cash flows 3%, that's as much as you can pay out essentially, after debt service, 3%, unless someone's raising additional capital to fill that gap.
Yeah, well, what's really interesting too, and I think there's a lot of misnomers, there's a lot of bad marketing, there's a lot of honestly fraudulent marketing where people just need to realize that the person who wins these deals in the space that you were playing in before prior to this transition to really only acquiring car washes and what we buy, which is, $30+ million asset class properties, there are multiple bidders on this. There's no real off-market opportunity. These deals have thin numbers.
Oh
There's
yeah.
multiple buyers here bidding this property up to get to the number we're talking about here and the number we're out there. There's no just mom and pop owners that have to get rid of it in this space. Now, there is a niche for kind of that sub 50 unit space where there is some really good spread and some value. Not as much economies of scale, not as much efficiency there, but there are unique situations there. If you're looking for the screamers, look in that kind of department. But there's very rarely situations like that. Even if a deal is getting foreclosed on right now and it's trading at paper, yeah, it's maybe a better deal, but just because it's a better deal today or it sounds good and that sounds attractive, realize there's more people there and groups like us are turning away those opportunities because it still doesn't make sense. Like this still needs to get digested. Maybe it's a bad piece of real estate. So don't get oversold on, kind of stuff that sounds like a buzzword, which is, off market, below paper, loan assumption. All this stuff gets priced into the marketplace, guys. Like I can't stress this enough. So from an expectations perspective, if you're an investor, just realize that these stuff, although it sounds really good, it might sound good to you, but the more sophisticated you get, stuff like that really needs to be talked about. And it's so funny, Chris, you'll appreciate this. When I speak to an investor or a fund manager, capital allocator, right, the two things I say to both of them is if you're looking for the highest projected returns, it was great talking to you, but it doesn't make sense. And if you're looking to get paid out the most as a fund manager, we're not going to be those people there because we actually project, and this is almost hackney, this is overstated so much, but frankly, pretty conservatively on our exit cap rates, on our assumptions. We're being very, I would say, more modest, but reasonable on those numbers to get there. So don't put yourself in a bad situation because you got oversold on something that you wanted to see, despite what reality might actually look like. And then cross-reference what that deal looks like to maybe another deal. If the numbers look too high there, we'll check their exit cap rate, check their rent assumptions there, because if the deal looks really good there and another deal maybe looks okay, but a little bit less sexy, but their other assumptions I mentioned there look lower, well, if you put those, more aggressive assumptions in the other model, I'm sure that deal actually might look better. So just as a PSA to all those investors out there, realize how you can kind of get not scammed or frauded, but how you might be getting misled with how these deals actually work out.
Most definitely. Yeah. Yeah.
So let's talk about your
comment.
transition
You
here.
said it great.
Yeah. Yeah. So let's talk about your transition here, how you found the car wash space. It's so unique and there's so many angles we can take here, but how did you learn about that? You mentioned that, the fundamentals change, the hot potato route, as I think might be the theme of this, the hot potato of multifamily, which was from 2018 to really 2022, right? Those worlds are different. The holds are longer now. Then you found this new asset class. So can we talk about that story and what really piqued your interest?
Most definitely. So what opened my eyes up is a lot of my personal capital I invest in alongside of our investors. And with the multifamily, I noticed the very little cash flow that was coming in. And so would I hear that from investors that are in other people's deals and, wanted cash flow. And I realized, in 2022 moving forward that the cash flow is going to be extremely tight given, each market, things like that. And so I went back to the team. I said, we have to pivot. And as acquisitions with companies, you have to make sure that you're bringing in acquisitions, you're operating deals, so the company's ecosystem stays afloat. And so after analyzing where the multifamily market was going, self-storage, I saw it to really follow multifamily. A lot of markets are oversaturated with self-storage. I wanted a sector that wasn't truly saturated by private equity, but private equity is interested in it, and that had high cash flow and high tax benefits, because that's what we all want at the end of the day. We all want high cash flow and we all want high tax benefits. You can take that high cash flow that you're receiving and put that into multifamily deals for appreciation that are 5 to 10 years down the road. But a lot of people want high cash flow right now. And so what I've realized, because even raising capital during the previous, 2022 and 2023 was very difficult, because investors can go put their capital in a money market account at 4.5%, 6%, depending on what institution you're with, and just have it sit there, and they know that their capital's there. They can call it whenever they want. So, if you're offering lower than that, it would be very difficult. So analyzing all that, funny enough, I worked at a car wash before college. I knew how profitable they were, but not to this extent. What I did was analyze all the market assets, and then I realized that in the car wash sector, it's around 80 to 90% mom and pop, and that private equity has not saturated it just yet. They are in it. Don't get me wrong. They're in it. KKR just came in with a huge investment on the West Coast. Thankfully, they kicked out those investors. And ironically, some of them live here in Charlotte, which invested in our first fund. And so after analyzing that 80 to 90%, I'll tell you some of the P&Ls we get are asked, hey, do you have a P&L? They're like, what is that? And now we have to explain it to them. And then we get it on the back of a napkin. And we're like, okay, you got to give us some more information here. So it really provides a lot of opportunity for us. But these car washes, the great thing is we own the underlying real estate. And so it's a real estate play as well, because we're buying in phenomenal locations. But we have the cash flow of a business, which produces anywhere from 45 to 55% net cash flow. And then the best part is, for all the real estate guys out there and gals, is that it's depreciated at a 15-year depreciation schedule. So the first Trump administration put gas stations and car washes at a 15-year depreciation schedule. So essentially, you have a very, very high depreciation. You can also take bonus and accelerated depreciation with these assets. So you get the luxury of high tax benefits. You get the luxury of high cash flow. We offer our investors 10 to 12% annual cash flow, and we're paying that out because of these sites producing so much cash flow. And then also we're in great quality locations, which helps overall. So very excited about it. It is highly operational type of business because you have a lot of equipment going on. So we have a COO that has over 12 years of car wash experience, where he built 2 other separate private equity companies, sold both of those separately off successfully. So we're excited to have him on board to do it a third time around.
Amazing. So let's get into the locations of where these car washes are. Do you have like a geographical cluster of these? How does that set up? Are you kind of looking all over the place? What does the acquisition process look like to you?
Yeah, acquisition process kind of very similar to multifamily. So we are focused in the Southeast, the Carolinas, Georgia, and Florida. We will look in Texas. We've looked at a couple portfolios out in Texas. We have one right now we're looking at in Dallas. And then moving in Q2 of next year, we'll be going up north. So we'll go up all the way from Virginia, Maryland, all the way up to Boston, Connecticut area. We like the Southeast, so we're going to hover on the Southeast. Right now, we have ownership in the Southeast, but we're going to hover all up and down the East Coast. And when it comes to these assets, we are really looking in great quality locations with high traffic count. We also check CoStar to see what multifamilies coming in on the market, what single home developments coming in on the market. We like to see the population growth. We really look at the traffic count. We look at the businesses that are coming in, median household income. We actually use a crazy software that tracks cell phone data. So we're able to track migration of individuals based off of their cell phone, which helps us tremendously when we go ahead and secure a location to make sure that we're essentially buying in the right location. Because at the end of the day, all of these loans are recourse loans. So these loans are recourse loans. They're not like multifamily where they're non-recourse. And even with multifamily, you still have the bad boy carve out and things like that. But these are all recourse loans. So we want to make sure that we are acquiring in a great location, because I'm signing personally liable, but that's also great because there's a very large interest of alignment with myself and our investors to make sure these properties perform.
Makes sense. So let's talk about, uh, I guess, what is your preference? Do you prefer to be in the area that's more established, or do you prefer to be in the area that, hey, there's, thousands of homes being developed over here. This is a newer site. There's maybe a little more upside here, but it could be riskier. What is your preference on that front?
Yeah, it's a catch-22. It's a fine balance. Ideally, we want more established areas that are always in more established areas are going to be growing in the outskirts around that established area. So that's always good. Very hesitant on going into areas that, project future growth. You can't predict what the city's going to do. City can easily come in and do a memorandum. I know here in Charlotte, South Charlotte, and Fort Mill, South Carolina, which is right on the border, it's Charlotte's MSA. A couple of years ago when we were in the multifamily space, they did a multifamily a clause where if you're building a multifamily complex, they're adding an additional $20,000 per unit to develop. That is huge. That's just a fee that they charged. And so, hoping that a development will come into place. I've learned my lesson throughout my decade of real estate experience is you can't really hope that the city's going to allow a permit to be pulled to develop. So we really like to be in the established areas or right there on the outskirts of an established area, knowing that the MSA or the suburbs are going to start growing from that whole established area, if that makes sense.
No, for sure makes sense. I mean, it's kind of like the thought of real estate investing. It's like the mirroring that is, hey, people are cash flow investors because I can't guarantee the appreciation of something, but the cash flow is a cash flow on something, right? And then speaking of, car washes and whatnot, there's a lot of misnomers about them, probably, right? Oh, I've even heard stories of people that invested in car washes and they fail. So
Yep.
I guess just simply, what makes a successful car wash and what makes one not successful, just on the most fundamental levels?
Most definitely. It definitely comes down to the team. The just like a apartment complex, you want a great on-site manager and sales associates, leasing agents to sell those units. So it definitely comes down on the team. You have to make sure your on-site manager is on-site, present, happy, and has a sales background. And then from there, it comes down to location. You need to make sure you are in the right location. I mean, we've turned down car washes that were producing 3.5 million in gross revenue. And keep in mind, we're operating at 50% margins of net, but just because that we did not feel comfortable with the area. We had to get comfortable with the area. I had to, and I did not feel comfortable with the area. So it definitely comes down to the area where you are located. Again, the fundamentals of real estate, I'm sure you remember this from real estate school, is location, location, location. You need to make sure you are in a
Yes.
great location. And so we go back to the
Yeah.
fundamentals of real estate because we own the underlying real estate. And it's just like if anyone's seen that movie, Founders with Ray Kroc with McDonald's, the biggest thing with McDonald's is they own real estate. And that's our fundamental of the car wash is that we own the underlying real estate in great quality locations where majority of our competitors do not. They've triple net leased their real estate out to other companies, other REITs, and they don't own that underlying real estate. And we're seeing it bite them in the butt. So our main thing is that we have to own the underlying real estate because we're real estate guys at heart.
Yeah. No, it makes sense. So when you acquire these businesses, are you buying them when the real estate is attached to on EBITDA, on cap rate? How does that make sense there? And I'm still kind of getting privy to the whole EBITDA world as opposed to cap rate, the whole NOI and how that kind of shakes out. But what do these usually trade off of from a terminology perspective and, how that might look different than a typical, multifamily offering, just to kind of educate those investors or fund managers who haven't really looked into this world of things?
Yeah, most definitely. So for those individuals out there that run a real estate investment firm that strictly buys real estate, you're buying off a cap rate. The higher the cap rate, the more cash flow you have, the better the investment. Lower the cap rate, riskier it can be. So when it comes to a businesses trade off of EBITDA. And so that's before your earnings, your interest, taxes, and amortization. So you want to make sure that you're buying properly. And each business trades differently. Each industry trades differently. back in 2022, car washes were trading at 15 to 20%, which is large. Any business on average would be anywhere from 4 to 7%. Like that's average what a business will trade based off of their revenue. And so what the most important thing is when you analyze it, you want to make sure that you feel comfortable going in at a certain EBITDA margin. For us, we're buying at 6.5 to 9, and we're only essentially underwriting an exit of 100 basis points on the back end. So if we're buying at 9, we're exiting at 10. We're buying at 8, we're exiting at 9. Where our competitors are buying at 10, 11, and 12, and they're exiting at 14 to 16. Funny enough, I got an email last night or a text message from an investor, and he was like, hey, did you hear about this portfolio in a certain city? And I said, yes, I've seen that portfolio. So he sends me the OM, and he goes, I'm thinking about it. And I said, I called him out. I said, you gave me crap for us being at an 8 to 9 at an exit. Did you look at their OM? And he says, no. And I screenshotted their OM, and their OM was a 14 to 16 at exit. And I said, you let me know how well that performs. And then he apologized for giving me crap. So it's all based off of EBITDA. Any business.
So what is that equivalent?
Go ahead.
Yeah. What does that equal out to kind of from a multifamily perspective? Like basically, because that's like the exit cap rate, right? What would be like the parallel that someone is drawing there from an exit? Because that's kind of the similar terminology, correct?
Yeah, similar terminology. I mean, the easiest way to understand, especially with the car wash sector, is we can run at 45 to 50% net profit margin. So if we're grossing $1 million, we can operate at 450 to 550 net profit in our pocket after all expenses and all debt services paid. So that's something that really we watch very closely is what is our net profit margins? Are they 20? Are they 30%? Can we decrease those expenses, increase that revenue when it comes to it? When you refinance or with that EBITDA, I mean, yes, other companies are going to look at it. It's really going to be industry agnostic. You have two large companies that are publicly traded, and so everyone kind of sees them as the big dog. So when they acquire or when they sell, they like to see, what did they do as an EBITDA to try to set the quote unquote industry standard. But there's really no standard. It comes down to, can you leave a little meat on the bone for the next buyer? And is there enough room to really increase rents increase customer sales, and then also increase memberships? Because the biggest reason why private equity dove into the car wash sector is that reoccurring revenue. You can have that reoccurring revenue hit the first of every month, and you're talking anywhere from 1,000 to 5,000 members at one site hit the first of every month, and that could be $100,000 to $300,000 on the first of every month, just cash flow.
So let's talk about the membership stuff, because I think everyone's at some point had it, forgot they had it, and then canceled it, right? So Can you kind of break down the dynamics of that and how it works? Do you typically acquire places that don't have a membership program in there? Or do you basically have, people sign people up for it? You kind of take that over. How does that all work? And what percentage of the revenue coming in from car washes are in fact from that kind of subscription model?
Yeah, great question. So just like you would have a leasing agent or leasing manager on site, selling potential tenants on a unit, we have that, but it's just with car wash memberships. So we have our sales associates that are at our kiosk. We are moving to pioneer the industry as the quote unquote Chick-fil-A model in the industry. Truly, we don't have kiosks anymore with any of our sites. Our older sites do. We're converting those. All of our sales associates have tablets, so they're going to be greeting you right there, right when you pull up with a tablet, introducing themselves. And then from there, their job is to go ahead and find out if you have a membership or not. If you don't have a membership, go ahead and explain the benefits on why you should be a member. And so for those individuals, that you're washing more than twice a month and you want a clean car, you're going to want to be a member because it pays for itself essentially. And so they get a little bonus when the member signs up, just like you would give, a leasing agent a bonus for signing a lease. And then from there, that first of every month, those individuals are billed. When it comes to a ratio, you really don't want to go over 65% membership to sales. Your most profit margins are going to be on single washes. So you want to make sure you're doing outreach and marketing throughout social media, throughout Google Ads. Your SEO is great. You're doing snail mail marketing flyers, which a lot of your mom and pops do not do. I will tell you that's why a lot of your businesses failed during COVID, is that the ones that did not pivot to do social media, online advertising, and things like that, they failed. They weren't able to grab the sales to keep afloat during COVID. And so a lot of them went out of business. But your ones that pivoted, and that's why I love the private equity space, is you have to be lean enough to pivot and to see that when you pivot, a lot of people during COVID made a lot of money. So when it comes to these mom and pops that we're acquiring from, they are essentially know nothing about marketing. We see a P&L and they may be, doing 4 to 5,000 a year in marketing. Our minimum budget is 45,000 for marketing because we want to over market in this in our areas, so we draw as much traffic as possible to our sites. So you really don't want to go over 65% because you actually make more money with the single wash sales. So there is definitely a balance ratio there.
That totally makes sense. So let's talk about what's in it for the investor. How does, when you're pitching these deals, how do you explain it to them? What are they looking for? Typically speaking, you're going to standard kind of investor coming in and whatnot. And then how does it work from an IRR perspective, cash flow to appreciation? Can you kind of explain and walk through what, a normal acquisition or maybe as a fund model, right? I don't know if you go in exactly as a fund. So maybe explain your capital formation process and then, how the return typically breaks out for, said investor.
No, I love that. And I'll also touch on our fund to funds model that we have as well. So all of our sites are in a
Please,
fund.
yeah.
And yeah, all of our sites are in a fund. So essentially, we want to diversify the risk. So when you invest, you're investing into one fund, which at minimum will have 4 sites, can have all the way up to 10 sites. It depends if we're buying a portfolio or not. Our first fund had 5 sites in there. So when you invest into the fund, you're diversified amongst all sites. You get the tax benefits of all sites. Keep in mind, all the investors own the underlying real estate of all sites. So how the capital formation is essentially we're getting a 70 to 75% LTV loan from a private community bank, which is normally local to the car wash or local to where the car wash is at in the city. Thankfully, we built a great relationship with a bank that really has given us a lead room of around 250 million of debt that we're able to utilize on these car washes. So we're utilizing that to our best of our ability. And the rest is going to be equity. So that rest is going to be equity to close the deal. And then also we raise a little more to go ahead and do renovations to make sure the equipment is to our standard, to make sure the POS, the software, the signage, the building exterior is to our standard. And then from there, these type of banks are depository banks. So they like to have a lot of reserves into the account. So you have to place anywhere from 8 to 12 months of reserves just sitting in the account. I always like to negotiate up it being in a money market account. So our investors, when we go ahead and return that in the 3 to 5 year hold, they can go ahead and get that capital back. Plus there's a return on that capital. Our hold period is 3 to 5 years. We offer a 10 to 12% annual return with monthly distributions. Those start within 90 days from us receiving your investment and or the first property closing in the fund. So we are offering 10 to 12% monthly distributions, and we are paying out those type of returns because these are high cash flow type of opportunities. And so that's the benefit of the cash flow. On the back end appreciation, our investors, depending on what amount, they get either a 60 or 70% of the profits allocated to them when we have that liquidity event. Our fund to funds model, which I'm very excited about for all those capital raisers out there and fundraisers out there, is we partner with Trivest, which I believe you guys have partnered with before. Love the guys over at Trivest.
We love them.
Yes, they are great. They're always on it. Love those guys over there. And so what we've done with them is essentially with our fund managers is we pay our fund managers a 15% annual return. And then they can pay their investors 10 and 12%, and they keep the difference. So how does that work? And there's also an 80-20 split with the fund manager on the back end. So how's that work? Essentially is every $1 million you raise as a fund manager, you get $30,000 a year in reoccurring revenue. And those are monthly distributions that you get for bringing in $1 million as a fund manager of a fund to funds. We only do the fund to funds. We don't do the co-GPs or anything like that. We only work with Trivest to go the fund to funds route, but it's very beneficial because you are getting reoccurring revenue for essentially creating your own fund and placing that capital.
Amazing. So do you often find yourself cross-selling against, dare I say, kind of hard money kind of investors and of that nature, because that cash on cash return profile is very similar to what you would get in a hard money, kind of fixed income debt route. But the benefit and the caveat, which is why this is superior, is because you probably get the cost segregation accelerated depreciation on this. So it's not treated as interest income. Maybe it's not as liquid, but the return profile is very similar, if not actually I'd argue better. And then you also get the tax benefit. Do you find yourself kind of cross-selling or maybe competing against those investors sometimes?
Early on, yes, not so much anymore, but you are 100% right. You have high cash flow, so it's very similar to like debt funds out there. But the big thing here is you're getting huge tax benefits. With our first fund that we closed out, we told our investors 60 to 70% of 2024 tax benefits, but we just got our information back from Madison Spec, and it's 83%. 83% for 2024 our investors are going to get. So that is very, very large.
Huge. So
Yeah.
anyone out there, yeah, I want to say just real quick, we're going to make sure this gets released sooner than kind of scheduled here, just for our back end. Not this means anything to the listeners because they'll hear it. But if you are looking for a 2024 tax benefit, we're not CPAs. We're not, anything of that nature. So not giving you tax advice, but reach out to Chris. He might be able to help you find a solution.
Yeah, no, I definitely appreciate that. And one of the big things too, which a lot of sponsors, both in any type of real estate asset class, do not explain to their investors is the way we have our back end exit structured with a refinance cash out. Our investors do not have to worry about the depreciation recapture. So when we have that liquidity event in the 3 to 5 years, they don't have to worry about the depreciation recapture, which a lot of sponsorship groups do not educate their investors on. And I can't tell you how many times when I bring that depreciation recapture up, they're like, well, what's that? And so that's one thing unique about ours as well, is that you don't have to worry about the depreciation.
That's called phantom income.
Oh, yeah.
Yeah. That's called phantom income. That's called you need to really know how it is. And listen, at the end of the day, there's no getting out of paying taxes. You just defer paying the taxes. That's how it works. So that's a very key note there. And a lot of times we actually do mention that because people want to know. And you say, hey, listen, you can invest in our deal. If you want to cash out at some point, you have to find another investment opportunity to invest in for it to make sense with how we do. So you basically do the refinance model. So you basically pay them out said return, and then you keep the real estate essentially under your kind of capital kind of structure, and ultimately hope to basically sell it probably bundled up perhaps.
Correct. Yep. Probably about maybe 10 to 12 years from now.
Perfect. So what is the 2025 goal as we wrap up here? What is the kind of the North Star? What are you looking to ultimately accomplish? What's kind of the blueprinted out final plan?
Yeah, 2024 has been a phenomenal year for us. Lots of growing pain, lots of growth. I will tell you that with 2024, we raised close to a little over $20 million just for all the things that we've done. For 2025, we are set our goals 20 minimum sites, which will probably raise around 50 million. So we'll probably double our raise in 2025 with a large amount of growth for all of our investors. And that's what we have set for the team. So I'm excited for it, excited for the growth within Aquashine Express and QC Capital.
Chris, thank you so much for being such an incredible guest. It's been a pleasure to get to know you better. Looking forward to watching your success, watching you grow, and watching the company scale and kick some butt in the new year, my friend. Thank you for coming on. Take care, everyone. For all those who are listening, we appreciate you, and we'll see you next week. Peace.